Everyone, good day and welcome to the Q4 FY26 earnings conference call of Ugro Capital Limited, hosted by Elara Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Jain from Elara Securities. Thank you, and over to you, sir.
Thanks, Rutuja. Good evening, everyone. We have with us the senior management team of Ugro Capital. Mr. Sachindra Nath, Founder, Managing Director, Mr. Pandey, CEO, Ms. Shilpa Bhatter, CFO, Ms. Ritu Singh, Head IR, and Mr. Siddharth Rajan, Head of Strategy. Over to you, sir. Opening remarks, please.
Thank you, Rahul. Good evening, everyone. I am Siddharth Rajan, Head of Strategy in FP&A, and I welcome to Ugro Capital's Q4 FY26 and full year FY26 earnings call. On behalf of the management team, I'm delighted to welcome all of you today. Before we proceed, I would like to draw your attention to the basis of comparison. FY26 and Q4 FY26 financials are on a consolidated basis, including Profectus Capital and Data Science Technologies Private Limited, whose acquisition was completed on December 8, 2025 and March 18, 2026, respectively. FY25 and Q4 FY25 comparatives are on a standalone Ugro Capital basis. All year-on-year references in today's discussion should be read with this change of scope in mind. I will now hand over to Mr. Sachindra Nath for his opening remarks. Over to you, sir.
Thank you, Siddharth. Good evening, everyone, and thank you for joining us. Before I hand over to Anuj, let me set the strategic context and long-term frame. On February 7, 2026, we communicated a structural realignment. The rationale was simple. After 3 years of building a 317-branch emerging market field network, acquiring MyShub Life for embedded finance, and acquiring Profectus Capital, the franchise was ready to stop doing all things and focus entirely on two verticals where Ugro has proprietary origination, superior data, and demonstrably better credit outcomes. The intermediated DSA-led book, business loan, machinery loans, prime lab, was yield dilutive, capital intensive in the wrong way, and not aligned with what we are building. EM LAP and embedded finance are. The decision was therefore clear. Stop the non-focus book and concentrate every unit of capital, distribution and management attention on the two verticals built for long-term annuity compounding. When we announced the realignment in February, we made 5 commitments, each with measurable FY29 target and each tracked publicly every quarter. The first, shift EM LAP and embedded finance to 85% of total EM by 29. Second, take out 220 crore of annualized cost. Third, run down prime intermediated portfolio at 50 to 20% annually. And the fourth, no incremental equity through FY29, growth funded entirely from internal accruals. The fifth, transition to be steady state annuity-led, largely cash ROA of 3 to 3.5% by FY29, with negligible contribution from co-lending and direct assignment income. I will close my remarks with this. After 1 full quarter of execution, all 5 are on track. Anuj will show you the operational evidence. Shilpa will show you the financial evidence. I will now hand over to Anuj, who will take you through the branch network, the productivity inflection, and the competitive mode in each of the two focus verticals. Anuj, over to you.
Thank you, Sachin. Good evening, everyone. I'll cover the operational performance this quarter and walk through the two businesses that are driving our next phase. Q4 FY26 is the first full quarter of the realignment in execution. Let me give you the numbers first and then walk you through the operational detail behind them. AUM is broadly flat quarter on quarter. That is intentional. The non-focus intermediated book is running down as planned, while the focus verticals are growing strongly. The mix of focus verticals has moved from 33% to 38% of total AUM in a single quarter, the fastest quarterly shift on record. We are on track. Net total income for Q4 grew 51% year-on-year and 34% quarter-on-quarter. PAT grew 26% year-on-year. Q4 also carries a one-time restructuring cost of about 25 crores, which was the cost of executing the transition cleanly. Excluding that, the underlying earnings trajectory is exactly where we said it would be. On the cost program, the consolidated OpEx base of Ugro and Profectus combined was approximately 750 crores last year. This will reduce to 490 crores plus in FY27. The takeout spans sales and sourcing structures, underwriting and credit layers, branch and support functions, and overheads, all linked to the intermediated verticals we have already exited. The emerging market lab built out is also complete. 317 branches across 13 states, up from 127 in FY24. The focus is now from expansion to increasing productivity per branch. Vintage branches, which are older than 12 months, are producing 68 lakhs per month in disbursements, approaching the management target of about 80 lakhs per month. Behind them, there are about 156 sub-6-month branches which are queued as the next leg of annuity growth. Emerging market lab AUM was at 3,581 crores in Q4 with a GNPA of 1.2%. Coming to the embedded finance business, which we do through My Shubh Life, which is structurally different. It is shorter tenure, daily EMI, average ticket size of 1 lakh, entirely digital, embedded within PhonePe, BharatPe, and other such payment ecosystems. Credit is underwritten on merchant GMV, transaction data, not on physical proximity, which allows us to serve at scale and velocity. AUM for this business has now reached 2,280 crores in Q4, growing 27% quarter-on-quarter, 6x growth in 15 months. GNPA is 1.7%, which is well within our underwriting expectations. Active merchant customers stand at approximately 2.5 lakhs. Yields for this segment are around 24 to 26%. Hundreds of millions of digitally transacting merchants in India, which are the vast majority without working capital credit matched to their cash flows, is the target segment for this business. Ugro, through My Shubh Life, has the platform integration, data infrastructure, and a credit capability to serve this segment at scale. Together, both the businesses secured annuity income compounding from the branch network and a high velocity yield from the embedded platform are complementary, not competitive. Infrastructure is also in place. I will now hand over to Shilpa for the financial detail. Shilpa, over to you.
Thank you so much, Anuj. Good evening, everyone. Please allow me to take you to the numbers in more detail. Interest income was at 415 crores in Q4, which was up 57% year-on-year and 26% quarter-on-quarter. Recurring net interest income on our balance sheet is strong. As the focus verticals grow, this line expands as a share of total revenue. Co-lending and direct assignment income was 155 crores, up 30% year-on-year. This line will reduce proportionally as intermediated disbursements stop, and this is purely by design, as we replace it with on-book interest income that accretes to net worth. Fee and commission income for Q4 was 33 crores, covering essentially prepayment income on loans and certain income on loan documentation charges and service fees. Other income was 25 crores, comprising of insurance distribution fees on borrower covers that we take, income from incidental debt syndication we earn when we arrange financing for MSME customers whose financial needs exceed our lending thresholds. and fee income earned by Data Science Technologies, our wholly owned subsidiary, which offers data analytics and credit intelligence services to financial institutions. Finance cost was 284 crores. Our cost of borrowings came down to 10.16%. This is for the fifth consecutive quarterly improvement that we have shown. This was also down 45 bits year over year. Each 25 bits point reduction at the current AUM scale is worth 35 to 40 crores annualized. OPEX was at 180 crores, excluding the one-time cost of 25 crores, which was related to the exit on the business vertical that we have done. The annualized savings program is on plan, and the balance will flow through in FY27. Credit cost was at 72 crores, 1.9% of average AUM analyzed, and this is well within the expected range that we intend to work on. On asset quality, GNPA stands at 2.5% and net NPA at 1.6%. We had a good coverage over the GNPA assets at 45%. Our stage 1 is at 93.1% of the overall AUM, and collection efficiency stands at 98%. The move from 2.2% to 2.5% GNPA is a denominator effect as the non-focus books runs down. It is essentially not a deterioration in the incremental portfolio. We are standing at a healthy capital adequacy of 21.2%, which is up from 20.8%, which we had shown last quarter. Our net worth stands at 2,906 crores with a very healthy leverage of 3.7x. Our debt stands at 10,782 crores, which is well diversified across banks, DFIs, and the debt capital market. We will essentially not require incremental equity through FY29. Our liquidity is comfortable. Our Q4 cash balances, which we held of about 1,800 crores, are being deployed. Cost of borrowing will continue improving. Thank you for your continued trust and support. We will now be happy to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may please press star and 1 to ask a question now. The first question is from the line of Rohit Arora, an individual investor. Please go ahead.
Hello, sir. Am I audible?
Yes, you are.
Sir, can you please explain the process of saving rupees 200 to 220 crore annually?
This 220 crores of cost save was on account of two strategic decisions which we took last year. The first was the acquisition of Profectus, and if you recall, one of the objectives of that acquisition was OPEX rationalization. So Profectus was also in MSME lending business with about 3,000 crores of AUM with a very large workforce. Ugro also had a very similar workforce catering to the same business. So when we acquired Profectus, there was a duplicacy in OPEX, and we had identified about 120 odd crores of cost which we had taken out at the time of acquisition. Additionally, in February, we did a realignment in Ugro's own business, where we said that intermediated, prime, lower yielding segments, we will stop sourcing. and all the costs attached to that, which included front-end sales and credit and other processing costs related to sourcing of that prime segment, roughly came to about 100 odd crores. So both those put together is 220 crores. All of that has got actioned. Some people are, especially on manpower related, are serving notice period, and the full cost impact will start coming from this quarter. But this was not an ongoing thing. This was a one-time OPEX reduction exercise.
So this quarter we can see this impact in profit and loss treatment in Q1 FY27 itself.
So some impact in Q1 will also start coming, while it is not a one-on-one correspondence that we have reduced 220 crores of OPEX. It will immediately reflect all of it in profits because it is also associated with the running down portfolio. And as we move forward, some of it will start getting reflected in terms of change in our profit profile. While our current lot of our current profits are on account of the co-lending income which we do, this will replace some of it with the direct annuity income. But yes, some of it will start reflecting from quarter one.
Sir, can I have one more question, please?
Yes.
Sir, tell me more about the customer profile which we are targeting and which we are focusing on increasing our AUM contribution.
So in emerging markets business, we are catering to customers who are micro SME, typically with turnover less than 3 crores, median turnover of about 1 crore. We do only secured loans there with ticket sizes between 7.5 lakhs to 50 lakhs. This we do in tier 2, tier 3 and tier 4 towns in India through our dedicated branches. Our dedicated sales team sources these customers directly. On embedded finance, the target segment are small retailers with turnover range between 15-20 lakhs to little higher. These are all retailers who are using some kind of payment ecosystem QR codes. We get embedded inside those payment ecosystem apps, and through that we read their daily transaction limits, apply our data science engine and make an eligibility. So broadly two segments, one where we are giving 7.5 lakhs to 50 lakhs of secured loan, the other segment of small retailer where the average ticket size is about 1 lakh, but we go up to 5 lakhs ticket size.
What is the average duration of these loans?
Come again?
Average duration of these loans, 1 lakh ticket size.
So the 1 year. The average duration is 1 year, and these are all daily repayment.
Okay, sir. Thank you, sir.
Thank you. The next question is from the line of Samir Dalal from Natwarlal and Sons Stock Brokers Private Limited. Please go ahead.
Yeah, hello, Mr. Sachindranath. I unfortunately wasn't there for the last con call, and which is why I'm going to ask this question. I want to understand why such a big change in the strategy on two fronts. One, eliminating a part of the business which contributed to 70% of your total AUM, and suddenly moving to such small ticket loans where the risk is a lot higher. The second, co-lending was something that you always specified. I remember you had done a meet with all the investors and analysts and all of that, where you said that we were one of the pioneers in the co-lending, and co-lending is such a great opportunity because we can sell down these loans at a lower rate, earning a spread without having the capital deployed. Why are you taking a call on not to do that part of the business anymore when it was so lucrative and which you were so gung-ho about?
Yeah, no, thank you. I think a lot of this we answered in the last quarter call as well. but I will, for the benefit of those who are joining for the first time, I'll summarize it. So I think you asked three specific questions, and I'll answer them in that order. First and foremost, that why we decided to exit from lower yielding, what you said, probably your understanding of better credit profile customer. So I'll answer that first. So you are right, Ugro was always designed and built for scale. When we started in 2018, we started with 1,000 crore of capital. Over a period of our 7-year or 8-year of journey, we increased our capital base to roughly around 3,000 odd crore. The premise was that over a period of time, the cost of borrowing would keep coming down. What we saw in the marketplace over a period of last 2.5 years, that the cost of liability is a function of rating, actually parentage plus rating, and multiple other factors. And we didn't see the same impact on our cost of borrowing. It has remained flattish, or it has come down by some basis point. Now, for the lower yielding prime DSA-led customer segment, you need a pricing advantage, because otherwise the economic value creation was not happening. We recognized this core challenge around 2.5 years back, and we were internally building the branch network to enter into small ticket LAP segment, and that network we built and took all the OPEX upfront in last 3 years itself. And when that got completed and we were confident that now we can pivot the portfolio on that as well as on merchant lending, we said that this is the time when we should make that pivot. Number two, your question with respect to the co-lending, we are still very gung-ho about co-lending. We still continue to believe that in order to improve the credit flow to deserving MSME and other segment of the market, a combination of bank and NBFCs is the best combination. However, there is structural challenge which we recognize over the last 2.5 years. Co-lending definitely requires asset classes which are lower yielding asset classes. Bank by its nature actually like to have assets which are lower yielding, more secure, what they perceive more secure. Now, whether you do that business in form of a co-lending or whether you do it on your own balance sheet, the structural margin still remain the same while you don't utilize the capital. Point being that if you lend at 14%, if your credit cost is 0.25% and your OPEX is say 3%, and your cost of borrowing is 10.5%, and if your co-lending rate is 9.5%, you are still making only 1% margin, right? And that is not accretive to investors, shareholders, to management, and so on and so forth. And link point to that is that while the co-lending, the income volatility on co-lending is very severe and high. Which means majority of the investors and also us would like to see a proper annuity flow. So when you take the asset on the balance sheet, you have an interest income which you calculate, while in co-lending it becomes volatile. In some quarters it can happen, in some quarters it does not happen. Second, the income or the profit which comes from the co-lending does not accrete the capital adequacy net worth. So suppose in this quarter, if we have done a 100 crore value of income which has come from the co-lending, for the purpose of recognizing this income for capital adequacy would happen over a period of time when this actually get realized, which means that this business requires more capital. Now, if you keep raising more capital and keep diluting shareholders at low value, the value creation actually become disrupt. And that's why once we got ready, we said that we will before that, the entire DSA-led intermediated model has now become one big, and inefficiency has come in, wherein these loans are churned at a very fast pace. There are large lenders which have cost of borrowing advantage. They take good quality customer from us and then they get transferred. So average maturity of these loans, keep getting reduced over a period of time. So keeping all of that in mind, we are not saying that we will not do co-lending. Co-lending will continue to be part of our component, but we wanted to increase the portfolio yield. We wanted to protect the dilution, and we wanted to get to 3.5% of ROA, and ROA which largely contributed by cash generating interest income rather than the co-lending income. So, so this is a 2.5 year of journey which we are internally preparing. Once we got ready, then we executed it, and the results are in first quarter itself. So if you look at our, this quarter disbursement on emerging market market lap, it is actually tracking to what we are projecting for FY29. Last but not least, you asked this question in which you said higher and riskier segment. Answer is, sir, both yes and no. What you presume or we presume is higher riskier segment. This may be true when you look at purely from the lens of GNPA. This is obviously not a customer which has a turnover between 5 crore to 15 crore. This is a customer which is below 3 crore of turnover. This customer has a potential to default higher than what a prime customer would be. So suppose we have operated in the GNPA band of 2.5%. Now once we fully mature in this would be in a GNPA band of 3.5%. But it doesn't change the credit cost metric because 100% of these loans are secured. They are again secured against self-occupied residential property, commercial property, and so on and so forth. So ultimately, even if the default rate is little higher, the credit cost would remain in the same band. And that's why on the credit cost adjusted basis, this is a superior business than to do a low yielding business. So it is
that would only be for the emerging markets portfolio, right, Mr. Nath? That because the embedded market lending business would not have the security.
Of course, you're right. And just to clarify, earlier also we always had a 30% portfolio which was an unsecured business loan portfolio, and we are replacing that with the embedded portfolio. So it is not that we did not had an unsecured portfolio, we had it. We are only replacing the business loan with embedded merchant lending. Our view is that the embedded merchant lending credit cost is far more controlled than open market business loan, predominantly the way the product is designed. It is a 1 lakh rupees of average ticket size of loan done on the basis of the payment data flow, bureau score, and deep integration with the payment platform and get repaid on a daily basis. So the credit profile, the credit cost, all of that is, if not, and also adjusted for the yield. Business loan was roughly around 18 and 19%. This is at 26%. So adjusted for the yield and credit cost, this is a superior ROA business without changing the overall risk profile of Ugro.
Okay, so the gross NPA going up to 1.7 says it's within your expected underwriting expectations. What would be a number of gross NPAs that we can expect to see in that business, and before which there would be a cause of concern or something that would make you think about this business strategy?
So, hi, this is Anuj. I'll answer this question. So when we had designed the product about 18 months back, and this is a 1-year tenure loan business on an average, we had projected a 4 to 4.5% GNPA here. And after 18 months, we have seen about 6 cohorts which have completed their life cycle. The GNPAs are 1.7. So we are quite comfortable up to 4.5%. And
okay.
at this point in time, it is doing much better than what we had ourselves anticipated.
Okay, and what can we how do you do the credit gross NPA recognition? Because this is a daily payback. Now, if a person doesn't pay back for a week, a month,
on the 90 days past due, the NPA recognition exactly remains the same,
but is stamped on a daily basis.
Correct. So now my question is, if you all know, you all obviously have early warning if the person is not paid for 10 days or 15 days. Do you start making any provisions for it, or you will not make any provisions? And can you just run us through how your provisioning cycling would be for these low small ticket items which are unsecured in nature?
So in general, unsecured we provision a little higher. So at the full portfolio level, for a stage 3 unsecured, we are providing about 75%. Here, depending on which stage it is, so up to 30 days he has not paid, he is in stage 1, and we will provide about 30%. Between 30 to 90 days, we will provide about between 50 to 60%, and after 90 days, we will provide about 75 to 80%.
Okay. Now, one last question, if I can. At the moment, you are growing your focus vertical by about, say, 17-18%, and you're talking of running down the defocused business at about 20% odd levels. So is it safe to assume that actual AUM growth for the next, say, 2 years would be zero kind of marginally here or there, because one side of the book, which is the larger side, is degrowing, whereas the smaller side is growing. So at least for the next year, there would not really be a growth in the AUM.
If I may answer this question, I think obviously a lot of people get focused on growth because I presume that the general perception is that growth leads to incremental profitability. Even if I take your assumptions on the AUM as right, but those assumptions does not translate back, to the bottom line. So to some sense you are right. If you do the math with the way we have given the data, 3,500 odd crore growing at 25% CAGR, roughly around 2,000 crore growing at 25% CAGR, and 10,000 crore going down. For FY27 it would be a flattish, and then you will start seeing a little bit of uptick on AUM. But the the bottom line is transitioning because it is replacement of a 15% yield portfolio to a 17% portfolio, and that's the transition. So what we have said we are going from scale to bottom line. So our DNA is of a scale, but that scale was leading to very large shareholder dilution, not value creative, and that's why we are now focused on bottom line than just sheer growth.
And also just to add, the running down portfolio, which is the prime portfolio, is all very long tenure. So it is not that it will suddenly come down. It will take its own time because typically these are 10-year LAP loans. So we have estimated 15 to 20%, and it will not. I don't think it will accelerate more than that.
No, I'm not denying that. I'm just asking on a general basis. About 15,000 will be probably the ending of FY27 also, and FY28 may be 16, 17. But like Mr. Nath said, I think the profitability is what is important also, and that if it rises, that's fine. I mean, I guess. So yeah, from that angle, it's fine. A
lot of people are listening. So obviously, when people think a company which has grown historically at 67% CAGR and now would not grow at the same rate, what's the problem? But I tried explaining that problem, that sometimes you have to choose between just sheer growth versus the bottom line. You need both, but at this point of time, for next 3 years, we think we have to focus on the bottom line, which is coming through this transition.
Fair enough. But only problem when you do that, no, Mr. Nath, this is just my observation, I mean, not a question, but because the bottom line is not growing, and if you do face some delinquencies and NPAs, the NPA percentage as a overall rises, because when your numerator is rising but your denominator is not, it kind of sends out a signal of rising NPAs, and maybe that is also the case. We are seeing this 1.7 versus maybe 1.5. I'm not sure exactly, and that also, and second, credit costs also seem a bit elevated. So the last question I would like to end on is, where do we see credit costs stabilizing given for the next 2 years, given we expect our loan book to be more or less flattish?
So we have estimated this on a very granular basis. We foresee credit costs to be in the zone of little less than 2, in the zone of 2%, but not more.
Fair enough. Those are valid points, and we'll keep a track on them. Thank you very much for the time and the answers.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all participants, we would request you to please limit your questions to 2 per participant. The next question is from the line of Amitabh Santhalia from SKS Capital and Research. Please go ahead.
Hello, am I audible?
You are, Amitabh. Please go ahead.
Yeah, hi Sachin, hi Anuj. Congrats on a good set of numbers and consolidation of Perfectus. I just wanted to reconfirm the final equity. I don't know if I joined late, so it may have been clarified on the call earlier. But just what will be our fully diluted equity for the sake of full clarity? Any pending conversions of CCDs or what we're seeing in March end is?
Now what you are saying is, sorry, kitna bacha hai? Only 2 lakh shares. So the only 2 lakh shares is pending conversion. Ye kiska bach gaya? Achha, okay. Only 2 lakh shares is pending conversion. Somebody's request has not come. Otherwise, what you are seeing is a fully diluted shareholding. So total outstanding shares should be 15 crores. 15.29 crores. 15.29 crores. Yeah.
Okay. That's so. What is reflecting in the March balance sheet is your final, almost, effectively your fully diluted equity.
Yes. 2 lakh shares to be converted, but it's yeah.
Okay. And there's no further dilution of warrants or anything from the past?
No, everything is done. Everything is done.
And all your CCDs are either matured or converted?
All CCDs are matured and converted.
Okay. So there's no non-interest bearing bonds or on your books as of now?
Nothing.
Okay. And what is our final, again, it might be there in your presentation, but just for the sake of understanding. So about your net worth, your adjusted net worth, what would that be? 2,900 crores roughly is your, I understand there's some amount which is, I'm forgetting the exact terminology, but there's some amount which is reduces your adjusted net worth too. If you can just help me understand that.
No. So Amitabh, there are two different things. So our net worth as of today is 2,906 crores. That's the net worth. I think in our last conversation we said that for capital adequacy purposes, RBI uses a different formula, and this net worth is net off against income which has come from the co-lending, which sits in the net worth, but RBI recognizes it for the purposes of capital adequacy when the cash gets realized. So you might be referring to that, but as of today the net worth is 2,900.
Okay, so our book net worth as far as the balance sheet is concerned, which is gross of NPAs, right, of 2,900 crores.
Yes.
Okay, and what is that? So can you just explain this part again, please? The RBI, the capital adequacy purpose, what RBI recognizes, and what this amount, how this amount gets realized, the differential.
I'll tell you the concept. RBI, what is the capital adequacy in the RBI balance? A capital adequacy is a buffer which protects lender of their financial institution against the future credit loss. So the principle being that the lenders their money should be repaid, and if there are losses through credit, shareholders should absorb it. And that's why RBI provided a framework of capital adequacy. For banks it is lower, and that's why they are much levered, and for NBFC it is combined 15%. You can take it in the form of tier 1 capital and tier 2 capital. Now, given that this is a buffer for future credit losses, RBI take more conservative view and says that the net worth for the purpose of capital adequacy should be a liquid net worth. So that's why things like goodwill, intangible assets are taken out from your total net worth. In our case also, the income taken from the co-lending, because you take the NPV value of the differential interest as a part of the income, but it gets realized over the life of the loan. So as and when it gets realized, it keeps getting added back to the net worth. So this is the difference and the gap.
Okay, and what would that difference be as on March 31st?
It's very difficult to, so the way to in simplest term, you should think of this way. Our debt to equity ratio is roughly around 3.7x, and our capital adequacy is around 20%, right? 21.2%. So theoretically, which means that on a capital adequacy basis, we are a 5 times levered, but on a net worth basis, we are 4 times levered. So that's the difference.
Okay, got it. Okay, thanks so much. That helps me understand better.
Thank you. The next question is from the line of Chetan from Behan India Fund. Please go ahead.
Hello. Hi, Mr. Nath. Congrats on the good set of numbers. I wanted to ask about the embedded finance business. Are the risk weights on the embedded finance business higher than the previous business that we are structuring away from? And do our NPAs overall do they include repossessed assets? And how do we resolve repossessed assets that we have gotten in the last 5 years?
Anuj? Yeah. So the embedded finance risk weight is same as any other loan as far as regulation is concerned, because all these are MSME loans, whether they are secured or unsecured, which is 100%. And on the repossessed assets, yes, we have been repossessing assets now and have very good experience on them for last 3-4 years. Typically, for assets greater than 20 lakh ticket size, we use SARFAESI, and the typical timeline of resolution in our portfolio is between 12 to 15 months. Post the NPA. So it typically takes about 3 months to get the SARFAESI order, and then about 3 to 6 months for a successful auction. While our own experience also is that once a definitive court order is obtained, in about 40 to 50% cases, customer comes on the table and settles.
Yes. And so on the unsettled, when you actually have to physically recover these assets, what is the recovery rate net of cost?
So far, in our experience, there's only time value of money because the time which it takes for recovery, but we have not lost anything. We have got our principals back. Actually, internally we. Yeah, go ahead.
How much cost do you spend on it as a percentage of those assets then?
Separately, that cost would be closer to 1%.
Okay, great.
Yeah.
Thank you very much.
Thank you.
Thank you. The next question is from the line of Adarsh, an individual investor. Please go ahead.
Hi, thank you for the opportunity. I had a couple of questions. First is Mr. Nath. Given that for the last 2.5 years, we were planning to move to a high-yielding book, what was the rationale now to acquire Profectus, whose yield is, I think, is much similar or compare? I think the ROA is sub 1% for it. And today we have, after acquisition, we are now running down part of the book and laying off people. So first question is, like, why make the acquisition when our intent was always to move towards higher yield?
Yeah. Can I answer that first?
Yeah, sure. I have 2 other questions, so just hold up.
No problem. We'll come back to that. So the reason why we could transition to this is because one of the reasons was because of Profectus. As you would remember that we said that we have been building the branch network. This branch network, got matured to around 300 odd. But the real profitability flow from this branch network would happen over a period of next 2 years. What Profectus helped us is exactly what when we rationalize. So we had this in mind that we have to rationalize. So basically we acquired a full company and the portfolio. Profectus had a total cost base of around 180 odd crore, and we have taken out majority of that cost. So now on that portfolio, there is a cash generation profitability coming, which is buffering for the OPEX which we have built out. So that is, and exactly that we replicated for Ugro as well. So it is about doing 3 things. One, adding a portfolio which we were confident of, improving our secured bit and reducing credit costs or managing credit costs. Third, extracting profitability which substitute for the future growth which will come from emerging market, and also substituting our co-lending income from real cash profitability. So a combination all of that was the tactical reason why we acquired Profectus. Also, it was an ROE enhancer because we paid roughly around 1,400 crore cash for a 1,200 crore net worth company, and on year 1 on 1,400 crore we are generating around 150 odd crore of profitability, which was roughly around 10 odd % higher than our existing ROEs.
Understood. The other question is slightly on the bookkeeping side. If I were to remember correctly, in the terms of the warrants and the CCDs, the CCD had a part of interest being repaid, I think around 12.5 and 12.5% back when the warrants don't get converted. Has that payment been done, and how is it flowing through the P&L?
Yes. Those payments towards the interest component of the CCDs have been done in December itself, and they have been adjusted from the capital reserves.
Understood. So those payments are already done, and even the warrants which are not converted, that is also flown through, I'm assuming, by now.
Yes.
Yeah. The last question is, if I remember correctly, the employees and promoters together have around 8.6 million, right, of ESOPs which are there for vesting. What are the broad terms of this? Is it a fixed price? What price is it? Given that there's been huge variation in the price of the last 1 year.
So in this time in slide number 20, we have segregated. So I'm defined as promoter, which means that I'm ineligible for any kind of ESOP. My ownership, which is through my company, my family, has little bit increased because it was, I think it was 1.98%. I increased it on 30th of March, and that's why it touched 2%. And employees have a pool of around 3.3%. Now this 3.3% is time vested. So I think so. But obviously you're right. The cost of or the grant price is much higher. I think so. The base of that for two different tranches, one is 202 rupees, and other one is around 130. Yeah.
Understood. What is the split? Which is 100 like? Is it majority 200 or 130, or is it?
I think it should be half.
Okay. No, that's helpful. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Rishi, an individual investor. Please go ahead.
Yes, hi. I'm audible?
You are. Thank you.
Yes. Hi, Mr. Nath. Congratulations on a set of good numbers. I mean, I have a question regarding the prospectus. I mean, I think you partially answered that for the previous caller, but wanted to know the school financing that prospectus is doing, is that part of what's being stopped, or is that still continuing? And if so, is that a third vertical?
So the school finance. Hi, Rishi, this is Anuj. The school financing book of prospectus was primarily a prime DSA source book at an average yield of about 13%. So while we don't want to get into that segment, but it's a product and there's a lot of insights as an institution. So what we are doing is we are expanding that products in our top 50 emerging market locations. So we will start doing schools, but of a smaller size at a relatively higher interest rates. So we'll continue this program, but with a little different perspective and policy. So the target schools would be from size perspective smaller and in tier 2, tier 3 and tier 4 towns with an average yields of about 16-17%.
Rishi, on top of that, what Anuj said, I just want to make sure that listeners of this call and otherwise, so we have a big network now. 318 locations spread across 13 odd cities, serving a set of self-employed small business customer. The potential of the network is immense, and in order to improve the productivity, we have to funnel more lending product to this network. But what we want to ensure first is to get to a minimum level of productivity and maturity for our core product, which is loan against property, and then gradually see what are the adjacency opportunities. And we'll talk about that once, in a few quarters. But obviously there is an underlying strategy, thought and execution rigor of adding more things in this network once the network for its core product matures.
Understood. Thanks. And also regarding the recent CDs that we have done, I saw that most of the rates were around 300 basis points more than the SOFR, which is roughly around 7%. I think we recently did a $20 million. What's stopping us, or is there a RBI mandate on how much we can borrow in this? Because the amount is definitely much cheaper than what our cost of borrowing is.
So there is no stopping from regulation on the amount that can be borrowed per se, but of course it's also availability which matters. So you will see that in the coming quarters the company will be looking for more such ECBs for two reasons. One is to reduce the cost as well as to better our ALM profiling given the longer tenor of profile these loans comes with. And just to make it amply clear, all the ECBs that we take are completely hedged for currency and interest rates. So the rate that falls to us is completely landed in INR.
So what he's seeing and what landed cost would be different, right?
That would be different. So you are seeing USD pricing, that is SOFR plus a spread, that lands to us, in an approximation of about 9.5 to 10%.
And currently, Rishi, the hedge cost has gone. Yeah, and currently the hedge cost has gone up, so that's why we are holding on to more ECB. But generally on ECBs, I think so there are two types of market for general understanding. One is commercial ECB lenders, which are big banks, trading, hedge funds, global trading books. They are normally lenders for AAA and AA, wherein they can just do ECBs, then hold it on balance sheet and then distribute and mature it. Most of the ECB lenders to us are DFI lenders, who are lending to us because of the impact which we create on the market through MSME financing and others. And there is not too much of the landed cost difference between our domestic term borrowing and ECB, other than that we get the tenor advantage. Most of our DFI ECBs are for much longer tenors. That's why we also prefer that. As our rating will improve, we will also start attracting commercial lenders in ECB as well.
Yeah, understood. Thank you very much.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello.
Please go ahead, Darshil.
Good evening, team. Thank you so much for taking my question. Firstly, congratulations on a great set of results. So just wanted to ask if I understand it correctly. So our primary business that we were having, the prime intermediary, we are going to run it down. So that, but currently it is the more significant portion of the AUM, and our emerging market and embedded finance, which are the lower portion, are going to increase right now. So for FY27, will we have the similar profitability? Because how would that work? I'm assuming it would be a higher profitability than what we had in FY26. So just wanted to understand what would you, how would we quantify, like in the current year, will we have like similar AUM but much higher profitability? What would be our ROA target for FY27, sir?
Yeah, so there are two things. One, FY27 is a transition year. In the year of transition, there are three things which we are endeavoring to do. First, obviously, making sure that our emerging market network and our merchant lending network, especially the emerging market LAP network, start maturing to good productivity, which is what we are targeting. From current base to roughly around 60-70 lakh rupees per branch basis. That's point one. Second, we are looking to transition and benefit from the cost save and transition our co-lending income, which is currently 25% of our total income, to gradually bring it down and bring most of our ROAs as income generated from cash interest income. So our expectation in the combination of the two is that, and that's why we have purposefully not given any guidance on an ROA for year-on-year basis, and all our guidance is on 2-year basis. Our assumption would be that purely the bottom line, ROA performance would be marginally better, and then it would step up in year 28-29 quite significantly.
Oh, okay, fair enough. So basically, FY27 will be kind of a transitional year, and FY28 where the big leap will come in, because our the emerging market will be more settled and we'll be able to have a bigger network effect, right? So just wanted to know, like, so for us, like, when when you will announce results, what are the items that we should also be keenly looking at, because we're not like in the day-to-day business. So what part of it should we focus on? What are the key performance matrices that you are also looking at, sir?
So in my opening speech itself, I said I think that there are 5 things which which we track and which you should also track. First is the portfolio yield shift. How much of, so for example, our December 2025, the emerging market and merchant lending was 33% of our total portfolio, improved to 38%, and by FY29 it has to be 85%. This is the first thing which we track. You should also track whether we are in that direction or not. I think so. The cost realization we have already completed, so you can't track it. Except that people make this mistake wherein they think that this 220 crore of cost realization is all coming from the P&L and should get added. It's not the case. When we say 220 crore of cost realization, it is a base cost of what was in Profectus and what was in Ugro. Now on consolidation, what was in Profectus is not visible to you. So the combined 750 crore of cost is going down to 490 odd crore. So the tracking number is that we should not breach total cost of around 490 or 500 odd crore, because we have said very clearly that our OPEX journey is over. So no more incremental OPEX. Majority of things are, that's why there is a compounding effect. Third is rundown of portfolio, so which we have said 15 to 20 odd %, whether it is more than that or less than that. If it is too much more than that, which means that AUM would shrunk very fast and income would drop. If it stays, it's better. Third is that we have said we don't need any equity, and then that is true. And fifth is transition to ROA. So transition to ROA, we have said, used a term, quality of earning. So you should see that whether our out of our total income, our 25% is co-lending and DA. I think so in this year it would remain high, but in next year onward it would start tapering down. So whether ROAs are increasing and whether the contribution in total income of DA plus co-lending is going down. If you track this, if we track these 5 things and remain near to that, then we will achieve our objective, and you should also track us and question us on that.
Fair enough, sir. And just last question from my end, sir.
It's on slide 4 of our investor presentation. I would definitely recommend that you look through that.
Yeah, for sure, sir. I'll look at it, sir. And I just wanted to understand, because like the segments that we are, trying to grow aggressively are very high yielding. So is there a possibility that right now maybe we have a somewhat of a first mover advantage, or it's our niche, but seeing this lucrative yield, there will be higher competition, and that can, maybe lower the yield that we are assuming? I understand that we have already assumed lower yields in our FY29 portfolio mix, but is there a chance that it might be, even more significantly lower? Because looking at the yields, more competition will come and there might be somewhat of a price war, or to get the good customer. How would you look at it, sir?
So yeah, you're right. This is Anuj. In any case, in any business, especially in lending, this kind of assumption would be broadly right. As things progress, the cost, as the overall yields will face a downward pressure. More so in prime intermediated segment, where not only the customer but the intermediary was also playing a part. In our chosen emerging market segment, while this is also true, the market is very, very well spread out and very large. And second, the core differentiation in emerging market today is the branch distribution network. So if you see and if you compare us with other larger players, we would be in the top quartile as far as number of branches are concerned. That is the reason why we invested in opening 200 new branches in last 2 years and have now reached a tipping point of about 318 branches. So it is possible slowly and surely the rates should come down as market eases up. but that I think has been adequately factored in our 3-year plan.
Okay, fair enough. Yeah, that's it from my side. Thank you so much.
Thank you. The next question is from the line of Saurabh Kumar, an individual investor. Please go ahead.
Hello, am I audible?
You are.
Yeah. So actually, currently, what I am seeing since last few quarters that we like either AUM is not growing or degrowing. So when can we expect like some growth, like at least 10? Because earlier, 2 years back or 3 years back, it was told that okay, we will be growing continuously for 5 years, 30 plus, and then now it is like a degrowing. So when can we can expect like the curve to come back to the growth phase?
Yes, you're absolutely right. I think so that our aspiration has always been to build a business of size and scale, because obviously we were motivated by the size of the opportunity in front of us. We were motivated by the core capability of the management and the kind of deployment of data analytics and technology we did. And we were very confident that we were, motivated by the fact that we can build a very large franchise. Having said that, over a period of last 2-3 years, as I said, in answer to a few other people, what we realized that between choice of scale versus the bottom line, this scale was not delivering the resultant bottom line to us, because these were verticals were low yielding. These verticals were, highly controlled by intermediaries, and the portfolio was getting churned. And structurally, these verticals require a very superior cost of borrowing, which was not coming to us because that, liability size have gravitated to certain set of NBFCs. And that's why deliberately we built an infrastructure in last 2.5 years, took all of the OPEX early, and now transitioning the portfolio. So that's our next 3 years of journey. While the growth, why all of you, all of us like growth, because growth means improvement in bottom line profitability. As a existing or a potential shareholder, your value creation is directly linked to the bottom line and sustainability of that. But in our case, growth was not delivering incremental bottom line. So now we would deliver first incremental bottom line, make it healthier, will not dilute shareholders, and by that time, the infrastructure would be ready, and then it will get to a normal growth rate cycle again. So what you are saying, so I think what you should track is the growth rate of our core portfolio, which will grow. So what you should track is growth rate in our emerging market lab business and embedded merchant lending business, because both of them would grow in the range of 25% and that's not a lower growth, that's a very high growth rate. Why the aggregate growth is looking flattish is because a lower yielding, less value accretive portfolio is automatically running down. I hope I've answered in some way.
Yeah. Thank you for the answer. I have one additional question. So now, we already have 300 odd plus branches. So will the OPEX come down significantly in the coming quarters?
So we are not doing any new investment. So OPEX as a percentage of AUM, as the AUM keeps going up, will keep coming down. So yes, OPEX next year as a percentage of AUM would come down.
Okay. And so we have acquired prospectus. So how many branches of prospectus we gonna keep running, and how many are we running down?
So prospectus was present in about 28 locations, and Ugro branches were also present in those 28 locations. So in all those locations, we are continuing with only one branch. Some of them are the original prospectus branch where we have vacated our premises with the prospectus ones which were very good, and in some we have vacated prospectus branches where the Ugro branches were better.
So normally for these, obviously this is also part of running the business, right?
That's right.
So, yeah. So just for the assumption, there must be some notice period and other things. So let's assume 3 months of notice period or 6 months of notice period. So we can expect like these 28 branch means 10% of the 10% of the OPEX or the running the business should come down by after 2 quarters.
So some of that has already got actioned, and some of them will get actioned. Yes, so you are right. The impact will start coming in.
So I think so. I think so. We would request you to look at slide number 13 of our presentation. We have taken a one-time hit of 25.4 crores. So all of the future exit cost has been taken upfront in this quarter.
Yeah. So the
notice.
I noticed that. So this is the part of the we have to pay if we are giving somebody notice period. Obviously we have to pay, right?
Yes.
It's like an upfront cost.
Yes.
But
we have provisioned it in this quarter itself.
Yeah. So I'm talking about savings. So there should be some savings as well, right, from this.
Yeah, of course. So that is why. For other questions, we were answering the total OPEX of combined Profectus plus Ugro last year was about 750 crores.
Yeah.
Next year, the total OPEX of the combined entity would be in the range of 490 to 500 crores. So there would be a 200 crore save.
Okay. So we can expect that in Q2 at least coming start showing some form of or other in Q2 onwards.
Yes.
Right?
Yes.
I'm not expecting Q1 because there are other challenges. But and one more thing. So now the integration is successfully done. So can we expect any credit update? Because it wasn't
any credit rating update?
Yeah.
So we actually last year got our outlook updated recently about 2 quarters back. So we are A+ outlook positive. Our internal assessment is that if we stick to our plan for this year, there is a very high chance of a credit rating upgrade next year.
On the lighter note, I would say it's like, rating agencies also act like investors, right? So you do all the hard work, but investors say, okay, we'll see the result and then we will action. Similarly, also is the rating agency. You do all the hard work, they continue to come back and say, oh, let us see, wait for the final result to come in few quarters and then we'll do it. So when you will act, they will act actually, while they are all interlinked.
Sure. Thank you, and so the results are good, and congratulations for that, and thank you.
Thank you.
Thank you. The next question is from the line of Mehul Panjunia from 40 Cents. Please go ahead.
Hello, sir. Thank you so much for the opportunity. Sir, currently, what percentage of our book is LAP versus non-LAP, and how do the GNPA yields and the credit cost compare across both these segments?
So our total secured portfolio, which I'm including machinery loans also because they behave similarly, is about 67% of the total portfolio, and the GNPAs there are in the range of about 1.5%. Our embedded finance portfolio is about 2280 crores, which is about 15% of the total portfolio. Here the GNPAs are about 1.7%, and there are certain products which we had discontinued last year, which included supply chain finance. We used to do a relatively liberal collateral product within LAP, which we used to call Sathi, and some unsecured loans. That all put together is about 3.2% GNPA. If you refer to our slide 16 in the investor deck, we have actually segregated our emerging market LAP, embedded finance, and other products with GNPAs.
And sir, what is the credit cost for these two segments?
The credit cost in embedded finance is almost very similar to the GNPA. About 70-80% of GN, so about 1.5-1.6% currently. As the vintage goes up, it will go slightly up and then stabilize. On secured loans, actually the credit costs are a percentage of GNPA. So about 30% of GNPA roughly gets translated into credit cost.
Okay. And sir, how do you see this mix in the percentage of secured versus embedded finance evolving over the next 2 to 3 years?
So we will continue. I mean, overall, our broad philosophy is that unsecured loans, whether they are unsecured business loans or embedded finance, should not go beyond 30-35% of the total portfolio. So we'll continue to maintain the same mix.
And sir, what was the mix before we changed the strategy? You mentioned that, because we were not getting good results on the bottom line, we have changed the strategy. So what was the mix before that between secured and unsecured?
The secured-unsecured mix was very similar. Within secured, there was a very large chunk of intermediated prime LAP, which was at 13.5%. So only that portion we are reducing. And we are compensating that with emerging market LAP. So the product category remains same, only the yield profile goes up.
Okay, sir, can you please elaborate a bit on, because, I am new to the company and these are all little bit quite techie thing for me. What is the difference between intermediate and emerging?
So intermediated business is the DSA-led business which we used to do in the top 25 metro towns in the country. So here the sourcing happens via DSAs.
Okay.
And the target segment was a customer with turnover between 3 crores to 15 crores. So relatively larger customers at a relatively lower yields. In emerging market, we have set up 318 branches in tier 2, tier 3, tier 4 towns in the country. Each branch consists of 5 to 6 direct sales team, one credit person, one branch head, one operations head, one collection head, and they go and source this micro SME customer directly. So this is the difference.
Sir, so can we expect a huge jump in our cost because, we have expanded to these many branches, plus we have hired people for these branches?
No, you don't. You shouldn't, because we have already incurred that cost in last 2 years. So all the cost investment in expanding these branches and hiring people is already over. So no new incremental OPEX.
Right. But still there will be a continuous cost for the salaried employees, right?
That's right. So that cost will continue, but that cost is already part of the OPEX which has been taken. And as the AUM built through these branches goes up, OPEX to AUM will keep coming down.
Right. So, sir, when we have last question. So when we had let's go back 2 years back, did we anticipate that we will move into this kind of branch-led strategy?
Yes, and that's why we opened all these branches, sir. So we have been building a 318 branch network. Most of our peers that have taken roughly around 8 to 10 years to get there. We have got there in period of 3 years. And that accelerated strategy was because we wanted to make this change at an appropriate time. We were hoping that our cost of borrowing, trajectory would go down. If that would have happened, then we would have continued all of the verticals. But since that was not happening, in order to, improve the bottom line performance, first we built the OPEX and infrastructure, and then we taken out the cost. Purely on the OPEX sense, so if you look at our slide 13, if you look at our FY26 cost, employee cost and other cost is roughly around 300 plus 285, 585 odd crore, right? And this does not include the pre-consolidation cost of Profectors because consolidation happened only on 8th of December. If you take that cost base also, this was 700 crore, and this we are just guided that would be around 490 odd crores. So that is what the business would operate. The portfolio of emerging market and embedded finance would continue to grow while the OpEx would remain flattish. So three core things. AUM on the front end would look like flattish, but underpinning portfolio would shift. Lower yielding portfolio would run down, higher yielding portfolio would go up, and that increase of higher yielding portfolio, which is increase in the portfolio yield, is not resulting out of incremental OpEx, and that's why there is an operating leverage opportunity.
Right. Sir, since you spelled out the 5 trackers, opening remarks, how many quarters do we expect to see a significant jump in the, bottom line?
So I think, sir, we said that the year of transition is FY27.
Right.
On till FY27, you should track us on these pillars and whether we are making incremental improvement or not. The real bottom line, jump. So we have given a guidance of 2 to 3.5%. I think so in the transition year we'll be in the range, but we'll try to achieve what incremental improvement over FY26. 27, 28 would be a first jump, and 28, 29 we think the business would fully mature at 3.5%, which is the top tier ROE performance for most of the lending institutions in India.
Right, sir. I appreciate a lot your elaborate answers, and all the best, sir.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to management for closing comments.
Thank you. I want to close with a context on macro factors affecting global economy and its impact on Ugro. We get a lot of questions on that as well. The global environment is genuinely uncertain. Geopolitical tension, trade policy shift, risk appetite recalibrating. India is not fully insulated. And yet, I'm more confident in Ugro's trajectory today than at any point in our history. The business we have chosen, small ticket secured, loan against property in tier 2 and beyond regions of Bharat, and merchant financing embedded in payment flows are not driven by the global macro. They are driven by whether a small business owner in Rajasthan or Telangana can access formal credit. That demand is structural, durable, and largely independent of what happens in Washington or Basel. The credit gap is 30 lakh crores. Our AUM is only 15,334 crores. We do not need new capital. We do not need rates to fall. We need branches to mature, and they will. We need our merchant portfolio to deepen, and it will. For the first time since Ugro's start, this company is now generating capital, not consuming it. Every rupee of operating profit accretes to the net worth and funds the next year of growth without asking shareholders for a single additional rupee. The management team's focus is singular. Improve operating metrics every quarter, reduce cost, increase yield, deliver on the 5 commitments we have made in February. 2 businesses, 2 large market, 1 focused institution. Thank you everyone for attending the call and listening to us patiently, and thanks for all the support. If you have any further questions, you may get in touch with Siddharth and Ritu or our IR team at investorrelations@ugrocapital.com. We would be very happy to answer and clarify. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Elara Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.